Well, the big global theme at the moment is the rapid decline of the US dollar. And it's not just our dollar that's surging. Canada's loonie beat us to parity this week. The yen has reached a 15-year high. China's yuan is at its highest level since it started trading in 1994. The Swiss franc has never been stronger. And to be fair, though, the US dollar is holding its own against the Bangladesh taka. As the US printing presses are primed to print even more dollars, tensions are escalating as the fiscal imbalances grow and nations fret about their ability to trade. Neil Woolrich reports.
The soaring Australian dollar is meant to be a boon for local importers, but not everyone is being taken along for the ride.
We deal with several currencies, not only the US dollar. The US dollar is not always the main currency in importation in food. Mostly we deal with the euro and the Swiss franc in our case. And those monies don't always move at the same pace as the differentiation between the US dollar and the Aussie dollar.
Fine food importer Patrick Lapissiere says his profit margins are getting some benefit from the higher dollar, but the increased currency volatility of recent years makes forward planning more difficult.
We usually had a more balanced exchange rate or a more predictable movement in the exchange rate, which allowed us to be a bit more preventive in our importation.
This week, the Australian dollar climbed to levels not seen since the currency was floated in 1983, breaking parity with the US dollar late on Friday night. In part, it's a reflection of the strong local economy. But the Aussie dollar has also been getting a leg up thanks to the so-called currency wars, the efforts by other countries to drive their exchange rates lower. Now, global economic leaders are calling for a truce.
This is still no time for complacency. And what we need today is not to embark on wars of any kind, but a strong and renewed commitment to confident and resolute cooperation.
So I think that everybody understands this, that there's no way for the global economy to be more stable, to achieve growth everywhere, if it's not done in a cooperative way.
Politicians hope a lower exchange rate will boost local exporters and kickstart their stalling economies, but analysts agree that such moves are typically self-defeating.
The devaluation of a currency only works if there is just one country that devalues. I think it is exaggerated to label this as a currency war. There is certainly a tension, but it is in no one's interest to escalate this tension into a full-blown war.
The scenario is not particularly good because obviously we are effectively in a zero-sum game, so we can't, all of us, all countries, devalue or revalue or try to push exports because at that point what you think is good for your own country, it might not work at the international level.
Putting at risk international trade, economic growth and employment. This week, the United States Treasury Secretary Timothy Geithner also argued there was no currency war, as Brazil's finance minister recently described it. But regardless of terminology, it's clear that tensions remain high between the US and China over the valuation of the yuan, also known as the renminbi.
It is broadly believed that the Chinese renminbi is undervalued vis-à-vis the dollar. This clearly favors Chinese exports into the US, and in the current context of a weak economic recovery, this becomes much less tolerable.
But Domenico Lombardi says even if the renminbi appreciates, it may not help American manufacturers because they produce different products to the Chinese.
The exchange rate issue is becoming really the proxy for a broader issue that concerns access to the Chinese markets. The US authorities are increasingly concerned about all forms of barriers that the Chinese are establishing, to protect access to their own economy.
Across the Atlantic, officials in Europe have so far shown no inclination to devalue their currency, but that could be a tempting short-term political fix to boost some ailing economies.
The euro area might decide, it is unlikely but it's not impossible, to enter this kind of policy intervention, because again the euro has strengthened quite a lot against the dollar, and that could be, and obviously the euro area needs to focus more on export in order to relaunch its own growth.
Here in Australia, authorities appear to be little more than interested onlookers as the global economic heavyweights trade blows over currencies. The high Australian dollar is making life difficult for some, like exporters and the tourism industry. But Australian shoppers have rarely, if ever, had a better time to buy from overseas, and the same is true for investors.
I, for one, am not going to put my head on the block and try to suggest when currency is going to peak, etc. But I am strongly of the view that the Australian dollar is significantly overvalued. The Australian economy, or large chunks of it, is very uncompetitive. And the markets themselves are telling us to take this spending power and go overseas and use it.
Mike Hawkins says many Australian stocks are globally facing industrials vulnerable to profit downgrades of 20% if the Australian dollar remains near parity with the greenback. That prophecy was borne out by CSL this week when the healthcare giant sliced $100 million off its full-year earnings forecast of around $1 billion.
So the market, I think, with currencies where they are, is not as cheap as the numbers suggest it is. So in a scenario where the currency continues to rise, I don't believe that'll be the case, but if it was to rise, I think the Australian market will clearly underperform. We'll see value destruction, we'll see ongoing earnings downgrades.
Attention now turns to the US Federal Reserve, which gave more hints this week that it's about to embark on another program of quantitative easing. That would inject more money into the US economy, but potentially devalue its already weakened currency. And it might make it harder for the US government itself to take a tougher stand against China.
The trigger is given by the forthcoming congressional elections in early November, and therefore there is a big pressure on the White House and the US Treasury to show that this administration has teeth.
Another sign that it's domestic politics rather than international relations that's likely to prevail and increase the risk of the currency skirmishes turning into a full-blown war.